Good morning. You're watching a live daily market outlook prepared by Windsor Brokers for Wednesday, 2nd of November 2011. The Greek drama remains the main driver of the markets, as yesterday's shocking announcement by Greek Prime Minister Papandreou of calling for a referendum in order to get support for the recent measures actually made a storm of criticism inside Greece and outside also from his European counterparts, as the agreement was nearly completed with the fresh bailout, the fresh tranche of the bailout for Greece. However, now everything is put on hold and the weeks of uncertainty are ahead of us, as Greek officials mentioned that the referendum should occur as soon as possible, but most likely nothing will happen until Christmas time. So another nearly 2 months of uncertainty and the situation that Greece will be at the edge between staying in Eurozone or coming out with the bankruptcy as the most likely scenario. Heavy criticism came from inside, especially from the opposition of Papandreou, with even the finance minister saying that he was not even informed about decision of Papandreou. However, yesterday's meeting of the cabinet gave result that Papandreou won the backing of his cabinet early this morning, actually, to hold a referendum on a 130 billion euro bailout package, but we'll find the Eurozone leaders who are trying to close the deal, and it's going to be harder to convince them. Today he's having a emergency meeting with the French President Sarkozy and the German Chancellor Merkel, just ahead of G20 meeting in the Cannes in France, and he's trying to also convince them and gain some support from the European Union. Some independent analysts see this as end of Greece membership in the Eurozone, and most likely the bankruptcy that will start in these days if things do not change. However, the Greek people from the other side are mainly against the recent plan and the measurements, as nothing optimistic comes out, as based on the calculation that Greece by 2020 will drop their debt to 120% of the national GDP, which gives very bleak outlook in the future years. We are not talking now about a short period of time. We're talking about minimum 10 years ahead of us. So most likely the Greek people will be voting. Now it's early to say, but atmosphere in Athens is heavily against, not only Athens, in whole Greece, but heaviest protests were in Athens. It's heavily against the current plan of saving Greece from the total collapse. Papandreou's actually decision was quite shocking yesterday, and it's seen as a gamble. And the heavy criticism, as I mentioned, came from inside and outside. Inside from the Greek opposition and also some cabinet members, while outside the partners from the Eurozone were simply shocked by this decision. The immediate reaction of the market, as we saw yesterday, was heavy risk aversion, pushing euro to the fresh 3-week low. Also, the commodities were heavily down. Some recovery was seen late last night and during the night session, continuing this morning, but so far it's seen as corrective, as most analysts agree, as especially for euro the technical outlook still maintains the short-term negative tone after reversal from 140 to 46, the previous high posted last week, accelerated on the negative news from Greece. Today's calendar is also actually quite full. We have a number of news coming from states. Actually, the main news are coming from United States. Before that, we have from Germany in approximately half an hour, 40 minutes, German unemployment change that is expected to drop to minus 10,000 compared to the previous month release of minus 26,000. From Eurozone at 9 o'clock GMT, final manufacturing PMI unchanged at 47.3 forecast for today. Then from UK construction PMI at 9:30, also unchanged. 50.1 is today's forecast compared to the 50.1 the previous release. Significant news coming from US at 12:15 GMT. It's ADP non-farm employment change, which is the main indicator of this Friday's coming US non-farm payrolls, and this is the private sector employment. Today's forecast is showing expectations of further jobs building up by 102,000 compared to the previous month release at 91,000. It looks quite optimistic, not significant change, but moving in the positive way. After this comes at 14:30 GMT crude oil inventories. Build of 1.4 million barrels is expected for today compared to the heavy build last week by 4.7 million barrels. And then we have the FOMC release of today's meeting today at 14:30 GMT. Expectations, of course, rates will stay unchanged, but the Federal Reserve looks set to take a breather from the monetary stimulus measures on today's release, after even if financial market turbulence heightens the chances of action later. The U.S. Central Bank actually is a debate over the course of policy, including a potential shift towards using a concrete set of targets for inflation and the jobless rate as policy triggers, comes against a troubled global backdrop and with the U.S. economy far from the full health. The U.S. recovery for now remains anemic and could be knocked off course if the Eurozone fails to tackle the crisis. The Institute for Supply Management, ISM, latest reports on U.S. manufacturing showed the sector slowing to a crawl in October, although the new orders increased. The U.S. economy actually grew at 2.5% on annual pace in the third quarter. This is significant improvement over the second quarter's 1.3% increase, but still too soft to put a dent in the nation's 9.1 current unemployment rate. We'll see also from the Bernanke's press conference that comes after the announcement of the rates, 15 minutes after. We'll see the steps that are decided by Federal Reserves for the coming period. Now let's take a look on the markets, see the latest movements, starting as usual with the euro. As we can see on the hourly chart, the outlook remains still negative as the pair suffered heavy losses from 142.46 last Thursday's high, dipping through some significant supports at 138, then 137, and the key support on the short term at 136.00. 136.55. 137.00 was the Fibonacci retracement level of 50% from 131.45 to 142.46, and then the higher platform of 18th and 20th of October at 136.55 was lost. The temporary support was found at 136.07 yesterday, and the current corrective attempt is underway. RSI is currently on the 4-hour chart is emerging out of the oversold zone, looking for a stronger correction higher, with the upside 138 zone seen as the initial barrier ahead of 20 days moving average, which is at 139, and actually is expected to contain the current bounce ahead of fresh weakness, as the also fundamentals that were the main driver of euro and the other instruments during past couple of days continue to show uncertainty and a negative tone. The most likely scenario would be the further easing of the euro dollar, as the near-term studies still maintain a negative tone. Loss of yesterday's low at 139.3607 would look for next target at 135.65, which is the low of 11th of October. Also the 61.8 Fibonacci of the entire move from 131.45 to 142.46, below which and most likely open way for further easing of the pair. On the daily chart also shows that pair broke below all moving averages, as the break above 200 days moving average proved to be false when the gains were capped at 142.46. Currently is holding below a daily 20 days moving average. That is still pointing higher, but generally outlook remains more weak. Losing of 136, 135.65 would signal the top at 142.46, and then focus lower for possible extension even to 131.45 in the coming short term price action. On the upside, we need to see a regain of 138.70, 139 in order to improve the current to ease the current bear pressure and turn the near-term focus higher. Holding below 138.70, 139 keeps would just confirm the corrective bounce and the lower top ahead of fresh weakness. The British pound turned its near-term outlook more negative, as the gains failed after marginal fresh high at 160, 164 posted on 31st of October, and the fresh slide losing 160 as psychological support and 159.64, the previous low of one day's low, actually 31st of October, finding support at previous low and the strong support at 158.90, also the low of 26th of October. As seen on the daily, the 200 days moving average is currently capping the upside, and on the downside, the limit is at 55 days moving average, which comes at 159, our strong support zone. Loss of 159 would further weaken the short-term structure and likely signal the temporary top ahead of fresh weakness. On the downside, will be looking for levels in case of a break of 159, 58.50 is the previous consolidation range ceiling as a stronger support, and also the 158.25, which is the Fibonacci 38, Fibonacci 60. One second. Fibonacci 38.2 of 152.71 to 161.64 ascent. On the upside, immediate barriers are at 161, 160, 93, 91, the low high of yesterday, intraday high, and 161 a psychological barrier. As the pair currently regained the 160 handle psychological barrier, it's extending slightly above. So we need to see break above 161 in order to signal double bottom and turn the focus higher towards 161. 64, break of which to open way for extension higher towards 162 level initially. Dollar yen remains in the near term narrow range directionless trading. Studies are flat at this point, but significant is holding above 78 and 77, 75, which is the low of the recent pullback after strong post-intervention rally peaked at 79.52. Holding above 78 and 77, 75 would keep some positive tone for a possible fresh extension higher. Clearance of the recent consolidation high at 79 and the previous high at 79.52 is required to resume the latest strong rally and open way for a test of 80.00 and then 80.23, which is the high of 4th of August 2011. And also before this we have 200 days moving average currently at 79.86. That needs to be clear in order to improve the broader negative picture that comes from 85.51, the high of 3rd of April. On the downside, loss of 78 and 77, 75 would risk further easing, but pending intervention from Bank of Japan might give some support, as bank officials mentioned in their statement that they are ready to intervene in unlimited number of times unless they stabilize yen away from the recent record highs that actually started heavily harming the Japanese economy and exports. So the intervention is still pending, and we might see some triggers in case of losing 78 and 77, 75, where likely the Bank of Japan might jump in the market again and intervene in order to further ease the yen's growth. The dollar Swiss picked up the recovery from 85.66 low of last week. Strong rally through previous high at 88.57 and the trend line at 88.90 has so far reached 89.57 high, ahead of 90.00 and 90.81, which is the key short-term barrier. The current easing is in corrective. It's so far been contained, but by 88.30 zone. However, the near-term studies are all pointing lower, and possible further easing is would be actually like a likely scenario, and further reversal into 88 zone is seen in the short term. Also, 88 zones at 38.2 Fibonacci retracement of the uptrend from 85.66 to 89.57. The near-term studies are, as I said, started pointing lower, and this might trigger some stronger correction at this point. However, on the daily chart, we have some signals of gaining strength, with the 200 days moving average currently at 87.25, giving the main support, and the loss of this one would weaken the tone and actually would be signaling the lower top of the short-term downtrend from 93.13 high of 6th of October, and possibly refocus lows at 85.66. Break below 85.66 would definitely be bearish, and signal further reversal of the recent strong uptrend from 70.67 historical low up to 93.13 high of 6th of October. The commodities are regaining strength this morning. As we can see, the crude oil, after initial easing through After easing it through initial $90 support, has dipped down to 89.16, just ahead of the 89 figure support, where the temporary support was found. Minor reversal of the broader uptrend from 74.94 up to 94.58 is seen. The near-term outlook now is regaining momentum, with hourly studies already above their midlines, but hourly RSI already in the overbought zone. That might signal some corrective pullback. However, on the upside, we need to see a gain of minimum 94.20 in order to fully turn focus to the upside and look for the retest of 94.58, above which to open our strong barrier at 95, which is Fibonacci 50% of the broader downtrend from 114.80 down to 74.94, and also 200 days simple moving average that stands at 95 zone also. So this is a strong barrier on the upside. As we can see on the daily chart, this is still seen as congestion and the consolidation actually here of the recent gain from 74.94, as 90 days moving average on daily chart holds the downside, and the 20 days moving average pointing higher already broke above 55 days, and now looking for a crossing the 90 days moving average. That would be additional bullish signal for the crude oil. However, clearance of 94.58 and the more significant 95 zone is required to resume gains higher. Gold is back to strength near term after dipping down through strong supports at 1700 at 1695, which is the previous high, extending losses to 1681, where the temporary support was found, ahead of fresh strength. Actually, the 20 days daily moving average contained the recent pullback. The daily studies are coming out into the positive territory. Immediate barrier 1741 to 55 days moving average, above which to open 61.8 Fibonacci retracement of the downtrend from 1920 to 1532, currently standing at 720. Need to say the break above previous height 1752 is required to trigger fresh gains. On the downside, immediate support 1700 as previous as a strong and figure support, ahead of 1695, 1681 yesterday's low, below which would further soften the near-term outlook. Failure to clear 1752 yesterday's, actually the last Friday's high, would signal further consolidation here ahead of possible extension higher, as I mentioned, wider picture studies remain quite supportive.